Welcome to episode 5 of series 3 of our OR Talks podcast. Today we'll be talking about property hot topics. Here are your hosts, Neil Seeger
and Marc.
That was easy for me to say in the intro, wasn't it?
First time.
First time, but then have I tried to say again, property tax hot topics. There we go.
I think just property hot topics.
A property hot topic, oh dear.
Yeah,
I'm adding extra bits into it now. So thanks for joining us. We're just having our little bicker about what the intro should have been, and I probably think I got it wrong. So today we'll be talking about key points for property tax and well, things that we did a talk, didn't we, a couple of weeks ago?
Yeah, we did talk to a group of landlords a few weeks ago, didn't we?
So we did talk, didn't we? And it was basically we got asked quite a lot of questions that I didn't probably think we'd get asked.
No, it was unexpected, which is good because it makes us realise what people sometimes are unsure of, doesn't it? So
yeah. So we covered the key points that we've been through before with the budget. So the drop in capital gains tax, dropping from 28% to 24%.
Yeah.
We also spoke about the stamp duty.
We did start with stamp duty, yeah.
So we spoke about the stamp duty. We also looked at inheritance tax sort of things as well, and whether you're better off as a self-employed person, as a limited company, and actually, in reality, it's a case-by-case basis.
Yeah, very much so, yeah. There was a lot of inheritance tax questions on there as well, wasn't there? So
there was at the end of it. We had opened the floor up to questions, and actually it opened it up to an idea for us to talk about during our podcast, really.
Yeah.
So we had somebody come to us at the end asking, as you said, about inheritance tax, and what was her case?
So hers was her father owned several properties, and it was the best way of them being passed down without unwillingly paying a massive inheritance tax. So it's all about the forward planning that we look to.
The forward planning. So we spoke about hers, and I can't remember the exact numbers, but if we just say something like it was £1 million worth of properties, we were talking about. So it was just her. Well, it was basically her dad owned them, and it was then passing between her and her brother.
Yeah.
And the confusion was that she was thinking if it gets passed to two people, that the inheritance tax thresholds would be split.
Yeah. So every individual has a £325,000 tax-free for inheritance tax.
Yeah.
And the confusion came from thinking that applied to her and her brother, whereas it doesn't. It applies to the estate that the assets are coming from.
Yeah.
Which is where the confusion is quite often arises. It wasn't just this lady; other people get confused.
Yeah, absolutely. Yeah, we asked a couple of times, didn't we? So it's not looking at them as individuals. It's what her father's estate was worth and what his allowance is worth. So he only has one £325,000 just for him.
He does, yeah. And where it gets even more confusing, is if it's a married couple, and when when the one partner dies, if the estate passes to the remaining spouse, then there's no inheritance tax payable. So in a sense, say the husband dies first, his £325,000 hasn't been used.
Okay, yeah.
Because he was married at his death, that can then be transferred to his surviving wife.
Right, yeah.
So then, in effect, she's got two lots of £325,000.
So she has 650.
Yeah, good maths.
Okay. Yeah, I tell you what, I'm not bad at this. I didn't have a calculator either. Especially after me when we last one, where I couldn't add up something like 19% or something. So then when we're talking about, in his case as well, there was £1 million worth of rental properties, and it was leaving the personal house as well, so their principal private residence, which was, I think, let's just say it was £500,000. So the whole estate was £1.5 million. And this got a bit complicated as well, didn't it?
It does, because when you're talking about a house that is being lived in as your primary residence, so not a rental property, if you leave that to a lineal descendant, which would be your children, grandchildren,
thank you.
You then also get up to another £175,000 that can only be used against that primary residence.
Yeah.
And this is where it can get really confusing, because again, go back to the married couple.
Yeah.
If it's all transferred to the surviving spouse, that £175,000 hasn't been used, so that can be passed to the surviving spouse as well.
So in that case then, so using that example, the £1 million of the rentals, plus the £500 house that's been the residential house, that's the primary residence. So that would have been, it was owned originally by a married couple.
Yeah.
Okay, the husband, using this example, passed away. passed it all to the wife.
Yeah.
Okay, so therefore they've got house worth, the residential house, £500,000,
Yeah.
£1 million worth of rentals. What happens then?
So using your quick maths, they've
Yeah.
got how much?
So they've got 325.
two lots of those.
Yeah, so that's 650.
Yeah, and then 2 lots of 175.
Which is 350. So that's £1 million.
£1 million, yeah.
Okay.
So that's going to leave 500,000 liable to inheritance tax at 40%.
Okay, so that's really simple, isn't it? Really?
It is. If anyone's managed to follow that completely, apply for a job here. 'Cause I'm really impressed.
But that's in reality though. It's understanding that actually that there is that extra allowance there,
Yeah.
and that actually that the individual who's been passed the assets, it's not their inheritance tax thresholds that are involved. It's the person whose estate it is that's passing the assets on.
Exactly, yeah, and that's where the confusion was coming the other night, really. Thinking that every individual receiving from the estate had that threshold. They don't. It's from the estate it's coming from.
So that was the inheritance tax question, which actually was quite. It was a complicated case, but actually answered quite simply in reality.
Yeah.
So then there's the confusion to do with all the one looking at repairs, which is a really grey area.
Comes up all the time.
Yeah.
Like we'll have conversations about this in the office probably on a daily basis, different scenarios and things, and what would you treat this as, what would you class this as? So yeah, very, very common.
So I think we were looking at in this quite simple case was you buy a property to rent.
Yeah.
So you bought a house. It's not in a condition to rent. So it needs some upgrades done to it to be able to be in a position to be able to rent it. So I buy a house, and I think the thing was looking at windows actually, and doors. So if I buy a property, so like I go and I buy it.
Yeah.
And it's just a normal residential house, but it's got let's just say it's got wooden window frames and single glazed windows.
Yeah.
At the moment, in reality, that I don't know. Well, I'm not a letting expert on it, but let's just say I couldn't rent it in that condition. If I replace the windows, would I get tax relief on that or not?
This is probably one of the most grey areas you picked here to quiz me on here.
Yeah. No, it's just, but it's the most common thing.
Yeah. So I'll caveat to start with, it depends. It's case by case.
Yes.
But generally, if you're upgrading something to a modern industry standard, you'll be allowed that as a repair.
Okay.
Although you're improving the property, you're only putting it to the equivalent modern day standard. So modern day standard these days, unless it's a listed building or something, isn't going to be a single glazed window, is it? No. It's going to be double, if not triple glazed.
Well, yeah, that's true. I'm old school with my double glazing.
Yeah. So yeah, that's where it becomes a grey between a repair and an improvement to the property. If it's a repair, or you're upgrading to modern equivalent standard as to what was there before, allowable for tax against your income. If you're improving the property significantly, no, it's going to go as a capital expense, which means when you go to sell the property, include that as a cost from your sale.
You save the tax then. So if I went to knock walls down, then I'm effectively, that's capital, isn't it?
Yeah, you're structurally changing the building then.
Yes.
Yeah.
So but if I come in, so here's another one that came up on the night actually. So if I was to buy the property again, I've done the windows, we've got tax relief on those, that's fine. And then I want to go and buy white goods.
Yeah.
So that's another bit of a grey area with white goods, isn't it?
Yeah. So generally speaking, the initial purchase of the white goods, you won't be allowed.
Yeah.
But then if you're replacing them down the line, you can have that as a tax deductible expense.
Okay.
It's called the replacement of domestic items relief it falls under. So many years ago, you used to have a 10% allowance called the wear and tear allowance.
Yeah, blimey, that's a good allowance. That is
taking you back there.
Yeah, blimey.
You got regardless of what you spent in the year.
Yeah.
That got scrapped probably 5 years ago.
Probably, and the rest, yeah.
Probably more. Yeah. Don't hold us to the.
What's to say? Disclaimer.
Isn't a history lesson, but yeah, when that got scrapped, they brought in this replacement of domestic items, so that if you're replacing an item that's already there, you can have that as an allowable expense, but not the initial introduction of that item.
That's a lot of people ask that question all the time, and it came up on the night as well. And actually, you know, there's people that are specialists in property that sort of ask us the same questions. So you know, it's more of an accountancy and tax side of things, isn't it?
It is, yeah, it is. But that's what we're here for, really.
Absolutely.
And as I say, everything is always case by case. So just because we're saying that's how it should work, it might be some cases where it works slightly differently.
Absolutely, yeah.
Which is why you should always be wary of the man in the pub.
Absolutely, the man in the pub. Me mate's gone and done.
Yeah.
So the other one that came up on the night was a stamp duty one, which was a really interesting question actually.
It was, yeah.
So this was a couple. If you correct me if I've got this wrong, actually. So it's a couple, and what they were talking about was, I think he had got rental properties,
yeah,
and she hadn't got a property at all, but they wanted to go and buy together.
Yeah,
that was what it was. So in that scenario, there, she's a first-time buyer.
Yeah,
and he's got rental properties, some in a limited company, some outside a limited company, had a mixture of the two. Where does that stand for stamp duty?
So because they were purchasing the property together,
yeah,
they're seen as one joint owner. So because one of them already owns residential property, unfortunately the whole transaction is liable to the additional rates of 3% because they already own residential property.
So you're paying 5%?
Yeah.
So even though it's a rental and they're buying a residential to live in?
Yeah. If you was replacing a main residence, then you can get around the 3%.
That was my next question. You already made me to that one. So the other example that we discussed with them was talking about, so if I had got a house that I live in as my residential, okay, and I'd also got a sort of a buy-to-let, and then I was to be buying, effectively replacing moving home, so replacing my primary residence with a new primary residence, I wouldn't pay the additional stamp duty.
No, because in that case you're replacing your primary residence, so there's a relief there that gets rid of the 3% surcharge basically.
So using exactly the same example again, but I'm replacing the rental property.
No, because it's not your main residence that you're replacing.
So it's only for replacing your main residence.
Yeah,
it's not replacing.
Yeah.
So if you're replacing, basically, if I'm just buying, even if I'm replacing or not, my rental property.
If you already own another property that you're keeping, yeah.
So only for your primary.
Yeah.
How interesting is that?
It is. Stamp duty is never straightforward either.
It isn't, but that's an interesting thing that I don't think many people are aware of.
No, there's little niches, isn't there, to it? So it's always worth getting involved.
It's always worth it, especially from a stamp duty expert.
Yeah.
So I mean, then we started talking about sort of like it was really interesting. We had a couple of other speakers there, didn't we? And the one I found really interesting was talking about property insurance.
That was really interesting. I learned a lot there. So.
Obviously, we can only tell you what we heard. Obviously, we're not advisors on this, but talking about under and over insurance.
Yeah, it's something I'd never really considered before. Like, I'd never really thought how that sort of worked.
Yeah.
Like, you just get your insurance and don't think any more of it.
Don't worry about it.
Yeah, the things he was explaining just really made sense, didn't they?
Yeah, because obviously people value their properties based on how much they'll sell it for.
Yeah.
But in insurance terms, it's what it costs to rebuild it. And I hadn't realised that, to be fair, either.
No.
And there was a lot of key points. So if you are a landlord and you have got, you should hopefully got insurance, and it's the things that are covered in property and accidental.
Yeah.
So like the bath overflowing, that's an accidental. That covers an accidental, but not structural insurance.
Yeah.
So there's all different policies out there. So some people I've dealt with landlords since actually that have got the buildings insurance, but not the accidental cover.
Yeah, they're opening themselves up then to the chance that if something goes wrong, they're not covered.
Absolutely. So let that be a lesson. We learned that on the night, that actually, if we are going to, there are insurance experts out there that will look at those and actually tell you if you are under and over insured. Because if you're underinsured, you're not going to be covered if there's a problem. And if you're overinsured, then you're paying too much.
Yeah, and I would say it's worth going. If you see these sort of landlord events advertised, it's really worth going because we learned something from there, and hopefully everyone else that was there learned from us. And hopefully.
Well, they put us on last as well, which I wasn't too sure whether they were saving the best till last or whether actually it was making sure that everyone was still awake to listen to the speakers.
Oh, probably they were worried they put tax and accounting on first, that everyone would have gone by the break, wouldn't they?
Well, the questions afterwards, I think we were the most interesting there. That's what I'm going with.
Let's hope the other people talking aren't listening to this now.
Well, if they are, then we'll listen to their podcast. They can say the same thing. But I think the one thing, there's a lot of points out there that when you are at those events, you can ask those sort of questions.
Yeah.
And it's the awareness that I didn't know those things were there until we presented.
Yeah. One other question that came up was, how do HMRC know that I'm renting a property out?
That's a really good question, actually. That is a really good question.
Yeah. And I think they were asking in general. It wasn't.
Well, we did call them out, actually. We did say we're assuming that you're not hiding the information here.
Asking for a friend.
Yeah, one of them. But what we did was, the way that we don't know how they did. Well, we do know. roughly how they find it. They have a big system called Connect, and Connect can tell them, basically what property you own, who's on the council tax that property.
Yeah.
It can also tell you what holidays you've been on. It can tell you what's your passport. Obviously, if you've been to Cornwall, then probably not. What car you drive, what house you live in, all those sort of things. And there's been a lot of what would you call what they call, not chase letters, nudge letters.
Nudge letters, yeah. Inquiries to see if you've got something that you should be declaring, basically.
And that could be for a multitude of reasons, but the simplest way I could think about it was the tenant, so the person living in the house registered for council tax, and the owner of the property are different people.
Yeah.
And that's a lot of people are on that boat, aren't they?
Yeah, and technology is becoming that sophisticated that all HMRC systems, the government systems, are all starting to talk to each other. And land registry is one that is catching people out left, right and centre now when they sell properties. This is a change at land registry, isn't there? The owner's changing, so then HMRC, if they don't get a capital gains return from you, will send a nudge letter saying, have you disposed of a property, X, Y, Z.
Should you have done a tax return?
Yeah. So.
In fact, this actually caught one of my friends out actually, and what happened with his case was him and his girlfriend bought a house together.
Yeah.
So then he's on the land registry, on the mortgage, everything. He then bought a house with his new wife. Okay, so he's now on 2 properties.
Yeah.
And what I hadn't realised this, that when he sells a property, his girlfriend sold the house that they lived in. So he still lives with his wife in their house. That's all fine. And they only kept the house to keep the mortgage term going.
Yeah.
All right. So he was paying towards the bills and whatever. When she sold that house, he had to pay capital gains tax on that property.
Yeah, but that would depend on how long he's been out of the property. But yeah,
in that case, I think the house had been owned for 7 years.
Yeah.
And he'd been there for 2 out of the 7.
Got you, yeah.
So he'd had to have, so there's a little bit of a proportion of residence relief.
But yeah, it still opens him
up. But you wouldn't think about that because he didn't buy that as an investor.
No.
He bought that to live in and then moved out.
That's how people get caught out with the rental income a lot of the time as well. I had it the other day with a client. So they had a house, they lived in it as their own home, didn't really think anything of it. They met someone, moved in with them, rented their house out, and didn't think anything about the income that they'd inadvertently become a landlord.
Yeah, that's it.
Income to declare then.
Because they're not making any money off it, because what they're charging for rent is the mortgage repayments.
Yeah.
But actually what people don't realise is that you can only save tax on the interest, not the capital repayment.
Yeah, exactly. Yeah.
So even though you're not making a cash benefit, you're still making a tax.
Yeah, so in their head, they're not a landlord, they're just renting out their old former home, it's just covering the costs. But for tax purposes,
that's not the case.
Yeah.
And that's surprising, we hear that an awful lot.
Yeah, all the time.
So those sort of cases, we didn't get asked that question on the night, but that one
up,
came.
Yeah. The accidental landlords.
Absolutely, there's more than you think of them as well. And there's all sorts you can think about. And then we start talking about the mortgage interest, and obviously we've done the mortgage interest on this one a few times. But that's something to, when we're talking about the benefit between a limited company and a sole trader or a partnership renting it in that way, there's all different benefits.
Yeah.
Some of them can inherit. It might be good for tax, but bad for inheritance tax.
Yeah, and it's whether you need the money as well. So if you don't need the rental income it's generating, a company might work for you, so you leave it in there, but you've got to draw it out. You're paying a double tax charge, so it might not be.
There's no again, it's a case by case, isn't it? It depends on what. And then do you go interest only or mortgage or basic capital repayment?
You're always going into financial advice there.
Well, you're probably wondering into it, but there's also all those that come up, and it's not just accountants that get involved.
No.
There's solicitors, there's
it's a
mortgage
team.
advisors. Yeah. I'm trying to think what other question. There was another question that come up, but I can't remember what it was.
What are you having for your dinner?
They didn't ask me that one.
No.
They might have done. I didn't. But a lot of those events are free as well.
Yeah, exactly. They're well worth attending, and
you do get some really, really interesting good advice. And the other thing that was actually interesting at the start of that, so you've got some of them are experienced landlords, some of them are first-time landlords, some of them are looking to become landlords. There's a whole mixed bag of people.
Yeah.
But what they were looking at when they opened it up, they started talking about where the trends were.
Yeah,
so
exactly. That was really interesting, yeah. How the market's sort of performing and things, so you're getting an idea of where to invest or...
What areas, what yields are in which areas, and it was a really interesting thing actually.
Yeah.
But obviously we're not trying here to sell the events, we're here to talk about the questions that we had, but those are the sort of the key ones that came up.
Yeah.
which, to be fair, I mean, we went there expecting no questions, but we walked away with quite a few.
Yeah, we were told nobody ever asks any questions at these things.
No.
Then we got absolutely inundated, which is good. It's good, it's what we're there for.
Absolutely.
We enjoy it, so,
and it's to squash those myths as well, isn't it? You know, actually, you know, coming to sit there and look at the landlord review, you not only do you find out that the insurance side of things, the mortgage side of things, and what the market's doing, but also you can find out a little bit about what the what's happening in the tax.
Yeah.
Obviously, you know, anyone that listens to this would have already known all the tax things, obviously, and would have been grilling us on the questions. But yeah, I think there's only other key ones that have come up recently that people have questioned.
Yeah, but if anyone's got any questions on property tax or anything else at all, please do get in touch. We're always happy to help. So. Absolutely,
yeah. And that's everything. I've got nothing else. Have you?
No.
Thank you for listening.
So thanks for listening. I hope you found that interesting. And if you have any questions on property tax or accounting, please do get in touch. You can drop us a WhatsApp on
01905 777 600.
Next time we'll hopefully be joined by one of our partners talking about international tax and how we get involved in international companies and strategies like that. So until next time.
Thank you very much.
Cheers. Bye.